essentially, the starting point here is that we've been here before. Unfortunately, debt crises and these kinds of debt episodes are all too common a feature of the longer term sort of history of the global economy. These kinds of episodes were called a hardy perennial by the late Charles Kindleberger of MIT, and they were also a subject of a book written by Reinhardt and Rogoff called This Time It's Different. Of course, the implication is, no, this time it's not different. Again, we've been here before. That said, over the past decade and a half, we've seen a huge increase in the ratio of global debt to global GDP, with both public and private sector debt rising quite dramatically and contributing. Not all, it's very important to say this. I mean, let me just say it a little differently. There are a variety of reasons for this very sharp increase. Some of it, very low interest rates, clearly that was part of it. Some of it, the so-called savings glut, referring to the fact that there's a huge amount of excess savings, if you can say it that way, especially in the emerging world that flooded into the developed world. Some of it may have had to do with deregulation in the run-up to the financial crisis. Some of it may have had to do with what some people have called the democratization of debt. Namely, it's not so much that the same people are taking on more debt, it's just that more people are taking on debt, if you understand that. And then government policies certainly played a role, especially in the US, in encouraging people to buy homes, encouraging people to take on mortgages. And then last but by no means least, the tax treatment of debt versus equity it clearly biases decisions in many respects. Good news is that after private sector debt rose substantially, especially in the decade of the 2000s, in a number of countries, not all, a number of countries, notably the US, UK, Japan, and Germany, it's come down, again, fairly dramatically. That's very encouraging. Unfortunately, at the same time, we've seen a spectacular rise, spectacular may not be the right word, but a very sharp rise in public sector debts. So that you now have in many countries debt ratios, public sector debt ratios, that are the highest level in peacetime. Now, again, good news, bad news. Good news is that with interest rates so low, the debt burden and the debt ratios in terms of debt service ratios, I should say, are manageable and aren't creating alarm at this point. That could obviously change as interest rates rise. So if I can get this next slide, there we go. The shallower slide is private sector debt. As I mentioned, it rose. For some time it's been rising, but it rose and then it's been falling, whereas, of course, the blue line, the public sector debt has risen pretty much across the world, but especially, one has to say, in the developed world. And you can see that a little bit here. Unfortunately, it might be hard for everybody to see all these lines, but let me just guide you through them. We're basically, this slide and the next one focus on the G7. On this slide, you have US, Canada, Japan. So let's just focus for a second on the US. The US is the red line. Again, you can see it rising and in the run-up to the financial crisis, and then since then it has fallen. This is the focus here is household debt. Whereas in other countries, Canada, for example, it has continued to rise. On the right-hand side of the chart, you've got public sector debt, and the real eye-popper here is Japan, of course. It already started with very high levels, and it has continued to increase. Japan is the sort of outlier in many respects. The good news, again, is that bad news is it's got these huge, huge debt levels. Good news is a lot of that debt is held internally, and so it's not as big of a threat as if it were held externally. U.S., you can see it's the red line. It did rise, but it's leveled off. I'll come back to the U.S. a little bit later on. Looking at some of the other four G7 countries, here we have France, UK, Germany, and Italy. UK is the green line, very similar to the U.S. Sharp rise in household debt and a sharp cutback as households deleveraged. And in the meantime, of course, you've had the increase in public sector debt. So you've had this switch going on in a lot of the G7 economies. I just want to spend a couple of minutes on the U.S. It's an interesting story. This basically is a repeat of the slide I showed earlier about U.S. household debt, but it takes a much longer time horizon. It starts the data in 1945. And the point of looking at this slide is really twofold. One is to say debt has been rising as a share or as a percent of household income in the U.S. for quite some time. This is not really an interest rate story, I think, because interest rates rose. They started off low during this, right after World War II, and then rose and then fell. And debt continued to rise until, of course, the 2000s when it took off. And again, a variety of factors behind that. Policy was clearly an issue here in the sense that there were a number of pieces of legislation passed in the U.S. that made it very attractive and very easy for anybody, basically, to buy a house. The big push on home ownership, which was one of the reasons. It wasn't the only reason, but one of the reasons why we saw this. By the way, corporate sector debt also rose in the early years quite a bit as well. So my point here is, yes, interest rates had something to do with it, but I think their role probably has been sort of overstated. If you look at this next slide, which is the U.S. government sector debt, this is an even longer historical span. It starts right after the founding of the U.S., and it follows debt, and of course you can see the big spike in World War II, and then it fell sharply, and then it rose during the Reagan years because of the Reagan tax cuts and defense spending, and then fell again, and then of course recently it's risen. The good news is it's stabilized. However, if nothing is done about programs like Social Security and Medicare in the U.S., this ratio will easily go up 10 percentage points of GDP to 15 percentage points of GDP in the next 10 years. So the U.S. has a big challenge ahead of it. Good news is, they managed to sort of stop the rise, but there's a big problem ahead. All right, so now let's switch gears a little bit. We've talked about the developed world. What about the emerging world? And here, there's a big issue, and I'll focus my comments fairly quickly here. And the big issue is Chinese debt. If you look at what's caused the increase globally, initially it was the developed economies. More recently, it's been the emerging world, and in particular in Asia, but of course in particular China. Essentially, the only way to describe it is the explosion of Chinese debt in the last 10 years is staggering, is the only way to say it. So Chinese debt in 2000 was about 120% of GDP, total debt. It's now about 280% of GDP. What was that debt used for? It's concentrated in the financial sector and in the so-called non-financial corporate sector. But just remember, most of these institutions are either state-owned or state-sponsored, often at the local level, not at the national level. So one way or another, this is sort of government-related debt. It doesn't show up in terms of certainly not the national debt statistics, but it is there. And at the minimum, you can say this is a contingent liability. What was it used for? It was certainly used to finance real estate, and a real estate bubble, one has to say, but also a huge, huge investment in industrial overcapacity. There's a huge industrial glut in industries like chemicals, automotive, steel, iron ore, and the increase in debt was used to finance that. The next few slides just highlight this. You can see, sorry, where are we? This is the increase in emerging market debt as a percent of GDP, of emerging market GDP, and you can see the rise very clearly, really starting. There was a bit of a rise right around the time of the Great Recession, but then subsequently there was a flattening out, but then recently it just took off again. And most of that is China. China's the green line in the slide. You can see the very, very sharp rise that's occurred really since 2009. And let's put this in context. There's the U.S. So if you look at private, non-financial sector debt in China, it is now much higher than it was right before the recession in terms of the U.S. Just to put the Chinese situation in context, I have these are 2014 the ratio of total debt to GDP around the world, and from top to bottom, at the top of the scale, as I said earlier, Japan. Next one down, Ireland, where we are right now, and then on down. But China's not that far down this list, and China is rising. Okay, the problem with China is even though the officials are saying we're going to cut debt, the debt is growing twice as fast as GDP. So that ratio is going to keep rising, and that blue line there is going to, in the next couple of years, is going to move up this ranking. There's no question unless they manage to get debt under control. They're not going to be growing fast enough to fix it on the GDP side. And then this next slide just shows you other economies. I mean, the US, UK are sort of in the middle of this category of countries, and the rest of the emerging world, the big emerging markets, are at the bottom, actually. So just to kind of wrap things up, the question is, where do we go from here? And this is sort of, hopefully will lead into the discussion of the panel. I mean, certainly it's evident in the last 2 decades that the tolerance for debt has increased. We keep hitting new records, or at least new peacetime records for a lot of countries. Now, what happens to that tolerance if interest rates start to rise, or as interest rates start to rise? That's one. Second, how are developed countries going to deal with this debt burden without hurting growth? Big, big challenge. Third, should we worry more about the rise in emerging market debt than developed market debt? And I think the answer is it depends. If a lot of that debt is in foreign denominations, obviously the answer is yes, because you've got the exchange risk in there. Is China somehow exceptional? There are people still saying that, although there are fewer of those people around these days. Or is it a big accident waiting to happen? The answer is probably somewhere in between those two. And then finally, is part of the answer the increased use of capital markets versus, say, banks? And there was some discussion of that in earlier panels. And this has, of course, happened in a big way in the U.S., and this is my very last slide here. You can see funding in the U.S. This is 1980 through 2010. You can see funding from banks falling, that's the green bars, and funding from the capital markets rising. So really the question is this the way of, is this part of the answer, part of the way of the future? So let me stop there. I don't think I shot my time too much, Keith. So it's back to you.
Not too much.
Not too much.
Okay.
Thank you.
Thanks so much for that, Nariman. So let's get into a bit of a conversation around some of those points and others. Brian, let me, if I may, kick off with you. So the panel was asked to consider the question, the role of debt. Can we get that out of the way, first of all? Does debt have a role? Isn't it just like death and taxes? It just exists. It just is.
It's got to be there for a long time. That's for sure.
But, okay, so how much debt is too much debt?
So
looking at gross debt to GDP ratio, which is very popular, gives a fairly, to Nariman's point, a fairly alarming picture. But presumably there are other things we should be looking at. And are you concerned about the level of debt in the global economy?
So when I think about debt and how it affects the economy and how it affects growth, I do struggle a bit to come up with a kind of magic threshold, a single number. Goes above this, we're going to have a crisis. Goes above this, growth is going to come down. The empirical work on that, I think, has not been that robust, to be honest. I find it much easier to think about the issue of debt dynamics. When a country is seeing the debt to GDP ratio rise very, very rapidly, then you know there is a macroeconomic problem, because the issue of solving that or bringing that debt under control, stopping the ratio of debt to income rising, that involves very obvious negative macro consequences. You've got to increase saving, you've got to reduce your spending, and that is going to push down growth, all else equal. And what it means is part of that is it's very, very hard for all sectors of the economy to deleverage in that way at the same time. I do believe in the paradox of thrift. I think that was a very insightful work that was done on that way back in the 30s by Fisher and others. If the government sits there and tries to keep its budget situation the same as the private sector is cutting its spending because they're trying to bring their debt under control, you won't achieve the private sector deleveraging that you're trying to do, because income will fall so fast that you'll be chasing your tail. So I think it was right for governments to step in and allow their budget deficits to increase when you had this private sector deleveraging process started very vigorously in 2009, 2010. And I think it was right for them to bring the interest rates down as well, because that's part of the debt dynamics equation, is the interest rate relative to the growth rate that determines how much you need to cut your spending to stabilize the situation. Obviously, the other response that you can make to solve a debt problem, bring it under control, is to stop paying the debt and default. But that's obviously very negative macro consequences near term as well. So you sort of have to have a phased deleveraging, if you like. You have to have the private sector does it first, and then the government steps in afterwards. Now, if you get to the point where it's happened and we're still going through it, certainly in the Eurozone, we've still got countries that are a long way away from the debt stabilizing level of fiscal deficits. But once you reach that point, then it's much harder to know what the macro consequences of a high legacy level of debt is. But there are 3 points I think that are worth making. First is just intergenerational equity. We're leaving our kids and their kids with a much higher interest burden than we were faced with. All else equal, for a given tax revenue, there'll be less to spend on health, less to spend on schools. So it's not fair, for a start, that we're leaving people we're leaving our grandkids with that legacy. The second point is obviously your capacity as a government to stabilize your economy when it's faced with shocks is much, much weaker if your government debt levels are higher. And the classic example there is Italy. So Italy didn't really have the banking sector, private sector debt, real estate bubble that the rest of the Anglo-Saxon world had, but it had exactly the same recession as everybody else had, partly because the government there could not expand its deficit when the external shock hit the economy. So and they've suffered a much higher level of volatility of growth as a result. So I think there's a clear relationship between growth volatility and the level of debt, but not so straightforward on the growth rate itself. And finally, and I'll come back to your question in terms of the vulnerability to an interest rate shock. It is actually our view, believe it or not, all this discussion, negative interest rates, it may seem a strange thing to say, but on a 5-year view, we do think global interest rates are probably going to rise. The US, I think, has made quite good progress in private deleveraging. That will allow the Federal Reserve to normalise interest rates. They're talking about that yesterday. So the US is the global interest rate setter. If we think the US is going in that direction, it will be very hard for the rest of the world not to follow one way or another. It's not going to happen in 1 year, even 2 years, but on a 5-year basis, it will. So that means that the interest burden is going to go up. The debtors in these economies are going to face a higher burden. Will the creditors spend the extra income they're going to be receiving? Well, possibly, but probably not, because generally they'll have a much higher saving ratio, the creditors. But then what if those creditors are outside the country? Then the higher interest payments just go straight out of the economy. And that brings, I think, to one of your other questions about the external borrowing. That clearly is a much more binding constraint, I think, for governments.
Yeah. Just on that point, if I may, on that specific point, Charles, last year the IMF sent out quite a big red flag about the level of external indebtedness in developing countries. And pointed to the increase over, I think it was a multi-year period. Is that where we're going to see some sort of event or a crisis? Having said that, the kind of panic around all of that kind of dissipated, really, has over the last year because interest rates are so low. So how should we view this external indebtedness amongst emerging markets specifically?
Well, it's made worse, of course, by the fact that China has been slowing down, so their ability to export out of it is reduced. So they're in trouble. And the fact that they're in trouble means that there are going to be constraints on the US from raising rates at all fast. Because the moment it starts raising rates, there'll be problems increasingly around the emerging markets. That will feed back one way and another onto the FOMC. So they'll be forced to raise rates really glacially slowly.
So do you think it's right that Governor Yellen in this case, she's kind of backed into a little bit of a corner in terms of what she would like to do from a domestic US policy perspective and the kind of impact that might have? This is a bit of a conundrum.
No, they're not backed into a corner because inflation in the US is still really quite low. I mean, if anything, below where they would like to be. And the great uncertainty is with the labour market strengthening in the US, the UK and Japan, when wages will start taking off. That will be the moment when there's a conundrum. And the problem will be for them then, if you raise rates enough to keep inflation down, then you're going to cause financial problems over a wide swathe of the rest of the world. So to which do you give priority?
Indeed.
But we're not there yet.
Just coming on that, I mean, I think the answer, where's the priority given? It will be a rerun of our dollar, your problem. I think if the US sees a domestic wage inflation, wage cost problem emerging in its own economy, at the end of the day, I don't think, unless they're convinced China is falling over tomorrow, because that would have a very big negative export shock on the US. Unless they believe that, I think they would go ahead and raise rates. As Charles says, they've got some time at the moment, but it's not going to last forever. 5% is pretty much there in terms of most estimates of the level of unemployment that the US can run without wages starting to pick up.
But we don't know.
I don't think they will take that choice.
We really have no idea where the natural rate of unemployment is. And when I was young, it was thought to be 2.5%. It's now 5%. It could go back. And one of the issues is that with the greater degree of globalization, the available labor force to you is not only your own country, it's potential immigrants as well, as we're finding in the UK. I mean, most of the increase in the employment over the last 4 or 5 years has been either from abroad or from older people.
If I could just jump in here for a second. I mean, I think in the end, while the Fed certainly worries about what goes on in the rest of the world, remember the U.S. is a fairly closed economy. Even though it's vulnerable, it's a fairly closed economy. So in the end, domestic considerations will outweigh international ones. Just to kind of throw out one number, we all love numbers. U.S. exports 1% of its GDP to China. Compare that with the 70% that's consumer spending. And that kind of puts things in perspective.
Indeed. So, Donal, on the basis then we get these sort of high levels and there's fears of debt kind of overheating and excessive debt raising and I guess to Brian's point, is acceleration of debt that's a concern and government's ability to manage that. Are there sort of object lessons we can take from governments having successfully solved their debt issues, or is it kind of a horses for courses world that we live in?
Well, I think, across the different regions, US, Europe and Asia, I think there's different circumstances that have driven a lot of the issuance and the debt profiles there. The US economy, I think, as far as I see it, is actually coming out of the first out of the gates from the financial crisis. The QE that took place there was implemented very effectively, and I think it's. I'm personally of the belief that the US will emerge from the crisis first, the strongest. Europe is in a different space overall. A lot of the balance sheets of the governments and of the banks in particular were badly impacted by the global financial crisis. So a lot of what the ECB is doing now, you could argue is similar to what was done at an earlier stage in the US. But I do think from a European context, it is actually quite necessary. So stage one, through the availability of ECB bond purchase program, etc. Governments have been able to extend duration, push out liabilities, help restructure balance sheets. So I think that's kind of well underway, and most of the debt GDP ratios of the main countries are improving. And then if you look at the banks, I think it's a challenging time for banks, okay? Primarily because there is a lot of regulation coming into play by 2020, capital related, and their ability to manage that plus lend into the real economy, I think it is potentially questionable. And I know that will depend on different countries, etc., etc. But I think what the ECB has effectively done is taking financing for large corporates, even out of the hands of the banks, which arguably is a safe route to go, and into the capital markets, which I think will probably be quite a positive thing, so that the banks can continue to restructure their balance sheets, continue to resolve non-performing loans, and continue to support what would be, the domestic growth agenda. And I think that is probably the right way to go.
Now, bearing in mind we're speaking at the ICMA annual conference, I wanted to perhaps talk about a capital markets aspect to that specific point. Brian, if we assume that debt raising move from the banking sector into the capital markets. One of the downsides is volatility of capital flows and event risk. Should we be concerned that away from the large multinationals, perhaps into the sort of SME sector, which is a large focus of the European Commission, which you just heard, are there other flip sides to sort of capital marketization, if I can put it that way?
Well, maybe I can try and answer that by sort of looking at what's happened in the US through the QE period, because actually through that period, bank lending has actually been pretty weak in the US. I think the level of bank credit is maybe just reached again its pre-crisis level, but the overall levels of debt have gone up, and it's been all capital markets issues, which has been great, but it tends to be the bigger companies that have access to that. And I think that it's probably true even in the US, the majority of the CapEx has historically been done by smaller companies. I'm sure that's true in Europe as well. So the QE has certainly helped raising bond financing, but I wonder if it's kind of leverage on the, sort of, for use of a better word than that one, its impact on the economy is actually less for each dollar of bond finance in aggregate. I wonder if there's as much extra investment as you would historically have gotten from an extra dollar of bank lending. It's the banks that kind of know the companies, the smaller loans. They go around and see the business and have a 5-year plan. I struggle a little bit to see how we get that done by the capital markets. If there is a way to do it, fantastic. But I think it is quite a challenge, personally.
Just to add something. I mean, I just want to pick up on Brian's point that recently there has been a pickup in credit growth, bank credit growth, if you will, in the U.S., whereas it's still lagging very much in Europe. And to me, part of the answer, I think, is what Donal was talking about, which is that the European banks are in poorer shape from a capital perspective and so forth than the U.S. banks. So QE is starting to have an impact, but only because the banking sector is relatively speaking, in better health. I don't think that in any way contradicts what you're saying, but I think it's just you need a healthy banking system for QE to work.
Yeah, but negative interest rates goes the other direction.
Exactly.
And QE2 and QE3 didn't do that much. QE1 did a lot. Yeah. After that, it hasn't done much.
Yeah, fair point.
I think at the end of the day, with respect to that debt raise, it's going to come down to what that's actually used for. Okay, there's lots of data to look at in the States, whether it's dividends, whether it's capex, whether it's buybacks, and I think overall it's equity holders that have probably more of a say there in that conversation vis-a-vis strategy of corporates and exactly what they're going to do. And I think over time that will play out in a positive manner. From a European context, buybacks just aren't really a feature of the European market. QE1, QE2, as this moves along, I think US QE took 2 to 3 years to kick in and show positive benefits. Okay, we're a year into this, so I think we need to wait to see the data to see what are large corporates doing with their cash. Is it M&A, which I would imagine is the first port of call, or is it investment? You've got to assume that if M&A is unsuccessful, it's going to impact local competition, and then the smaller players are going to have to invest to grow to compete. I mean, this is just the natural cycle of things. It does take 2-3 years to really play out, though.
Do you think, just if I'm to stay with that on that point, Donal, so particularly in the US, the levels of debt raising have been extraordinary, given following the cycle, and a lot of it's gone to share buybacks, to M&A, and to your point. Is this storing up real problems for the future? Because it's not used for capex or productive investment. Depending on your point of view, people think it's being wasted, or it's being used by corporates effectively to fund their bonus schemes and whatever it is. It's not productive use of capital. Do you sort of support that thesis?
I think, buybacks stand alone. If that's what everyone was doing with excess cash, you would have to conclude it's not a positive thing. Okay, but the genesis to this is, 1982, corporates having excess cash and either sitting it on their balance sheet or making ineffective or unwarranted purchases. So this is why kind of buybacks appeared as a feature. So it's a tool in a corporate's armory. I think, like anything, if there's too much of one thing or too much of another, it's going to be unhealthy. But ultimately, I think it's down to equity investors as much as anything to help define and ensure that the rationale for a buyback, a dividend payment, or capex is absolutely clear. I think there is socio-economic point in there. Okay. Share schemes, earnings per share targets, etc., which seems pretty unpalatable from a European perspective. Hence, it's really not a feature of the market. The US, obviously, much broader capital markets, and I would argue that that over a period of time, the natural equilibrium is found, and that I don't think it is an overly dangerous concept in itself. But I would defer to my US panel.
No, I mean, I don't disagree with what you said. I would look at it just a little differently, which is to say this is a very rational response to low interest rates and to a tax structure that's biased very much in favor of debt over equity. I mean, I don't, from a social perspective, I'm not saying it's a good thing, but I'm just saying it's a rational response to the set of incentives that you have out there and a set of market signals.
And if we don't like it, we ought to change the fiscal balance.
Exactly. Yeah. Exactly.
So in terms of alternatives, Charles, to debt, are there alternatives, either at the government level, I guess at equity, but broadly speaking, there's been lots of discussion over the years about, I guess it's different types of debt, but amortizing debt structures to get away from this notion of governments and companies always rolling over, never paying their debt back, or some kind of, GDP kickers, or some kind of commodity or export kicker. Are there alternatives that you could point to and say, look, this is what companies or governments should look to as alternatives to straight kind of fixed debt?
Yes, there are. And changing the fiscal balance is a fairly obvious one. And I think the other thing that really got us into trouble before the great financial crisis was bank finance of mortgages based on wholesale funding. And there simply wasn't enough equity in the housing market. We need to change the housing market. There's a very good book by Meehan and Sufi called The House of Debt, arguing that there should be very much more equity element in housing finance, and we need to think about that too.
Brian, do you have any thoughts about that alternative?
Well, just sort of going back to maybe the previous discussion a little bit. I mean, I do think there's been an element of just sort of financial re-engineering which QE has encouraged. I mean, when you go back to the point I was making about deleveraging, you've seen the US corporate sector running massive financial surpluses the last few years. So the surplus of operational profit over capex since 2009, we think, has been cumulative $2 trillion. Now, you'd have thought that would have given them, if they wanted to deleverage, that would have given them a lot of scope to pay down their debt. They've actually taken on even more debt. And where's the money gone? It is precisely as Donal was saying, it's gone into the equity buybacks. It's really hard to see how that particular element has helped the real economy. Would having even more QE really make a difference? I'm not sure. I think we are kind of reaching the limits of what central banks can be expected to do and to help here. We're getting increasingly radical. The unintended consequences of all these policies we've already heard today seem to be getting more and more of a worry for everybody. Maybe you just need to be content. 2.5% growth, 2% growth, it's not the end of the world. Why should we be kind of pushing all the parameters of the monetary fiscal framework harder and harder just to maybe get 3% for a couple of years? Yeah.
But Donal, talking of kind of rational responses, the flip side to be it negative or zero interest rate policy on the buy side has been to basically pretty much do anything they can to generate yield in whatever form that might be. And that's led a lot of investors to buy things they wouldn't normally poke a stick at. And so, be it sort of a long-dated, deep capital, or down the capital structure, down the credit curve, into alternatives, be it real estate or infrastructure, which we heard a bit about this morning. And this is by people who haven't really got experience of analysing, assessing, pricing that sort of risk. So does that concern you?
Yeah, no, certainly a good question. I mean, one of the consequences of QE, probably not fully foreseen at the beginning, was, you know, the impact that negative interest rates was going to have, okay, on the financial system. So European financials generally not a loved asset class by the investment community, primarily for that reason. Well, some would argue that that's QE at work, pushing people out of, you know, certain asset classes into more riskier asset classes. I think there'll probably be some winners and losers along the way. But if QE works as it is supposed to work, and the economies are reflated, inflation rises, well then that zero interest rate environment or negative interest rate environment should actually change and normalize. Okay, so that's when it's all going according to plan. The negative scenario of, you know, negative interest rates or even lower rates in Europe for a period of time greater than 3 years that would be problematic for the financial sector and for other areas as well.
And just as I won't ask you to comment on AIB specifically, that would be unfair. But given that you work in the Treasury sort of area, from an issuer perspective, this is too good to be true, is it? I mean, how do you weigh up the fact that you can raise debt at LIBOR flat or below, and you've got investors to keep happy? It's a balancing act that strikes me as being a very difficult one at the moment.
There's lots of DCM bankers here who've been trying to track me down all week to ask me that question. So maybe I can answer it and fulfill all of their questions at the same time. I think what's going to happen in Europe is quantums of debt for banks isn't going to change, quantum of liabilities, but the form is going to change. And a lot of that is, like I mentioned previously, around regulations. Everyone will be, you know, aware of TLAC, MREL, depending on the institution and how it's going to impact you. That has a material impact on banks, okay? There will be situations whereby, and many banks will have to issue these eligible instruments, even if they don't need them from a liquidity perspective, but just to meet regulatory requirements, they're going to have to. So the horizon and the investors are going to, you know, be challenged, I think, over the coming years, just to deal with the volume and the amount of different liabilities that banks are going to issue. But I think it's manageable because the quantum is unlikely to change. It's just the form is going to change. And it's quite well flagged, but I think as we come to 2019, 2020, as a lot of these ratios harden up, I think there's going to be a lot of capital markets activity.
Yeah. Okay. I'm conscious that we're almost out of time, and I guess we're running over time as well. So I wanted to, I'll ask our panel just to make a very, very brief, I guess, closing sentence rather than statement. But before I go there, are there any questions, any urgent burning questions that anyone has for this wonderful panel? All right. I think there's a microphone, yeah.
Sean Egan Jones Ratings Company. I have two questions. One is, does a panel still believe that Reinhart and Rogoff is applicable? And the second one relates to the debt that they suggest constrains growth, and appears that we're in that period right now. What are the ramifications of the central banks who own a lot of sovereign debt simply writing it off?
Should I go at the Reinhart and Rogoff question?
So, Rogoff and Reinhart, there clearly was a very perceptive piece that was published at a great time, and has proven, you know, the growth is going to be really disappointing after this financial crisis, is basically what they said, and they're absolutely spot on with that. I guess the aspect of it I would pick up on, though, and I think this is something that Ken Rogoff himself has admitted, is that they never said this would be a permanent process of deleveraging. It would be a long process, a painful process. You know, the two phases that I talked about, the private sector goes first, that pushes the government's balance sheet into a bad place, then they have to respond. You know, it would be a protracted process, but it's not something that would go on forever. And I think even Ken Rogoff has come out and said that. And when we look at the US economy now, and particularly how much household debt ratios have come down, corporate debt ratios, corporate debt to profits anyway, looking okay. We think the first phase looks like it's completed in the US. Federal government budget deficit is starting to come down now. So I think they never said that there'll never be any light at the end of the tunnel. They just said it will be a long process. And I think in some countries now we can see that light at the end of the tunnel. In the US is closest. I think in Europe we're a lot further away. But once you're into the second phase, of course, once you've done the initial stage of reducing your borrowing, it progressively gets a little bit easier. So in terms of what actually drives the growth rate from one year to the next, it's not the fact that it's the pace at which you reduce your fiscal deficit. And I don't think the level of debt is necessarily a big deal. I mean, look at Ireland and Spain. We've still got two economies with staggeringly high levels of debt, and they're both the strongest growth economies in the Eurozone. So again, that come back to my opening point, that the level of debt I don't think is so easy to relate to the growth rate. But there is light at the end of the tunnel. I think even Rogoff and Reinhardt made that. But in terms of the 90% of GDP level, that's going to constrain growth. I'm not convinced by that analysis.
Well, if I could just, I agree. And the 90% is not a magical number. I mean, it depends a lot on where interest rates are. I mean, if interest rates were to go to 5% or higher, I mean, short term, then I think 90% may be a more relevant sort of number, whereas at these very, very low interest rates, 90% doesn't seem to be a problem. So I think it very much depends. I mean, it's not a constant number. It's a sort of a sliding scale, if you want to say it that way. Where I think Reinhardt Rogoff is very relevant today is China. Now, that said, I don't, and I think my fellow panelists probably agree, China's not going to have a meltdown like the U.S. did, for all the reasons we know. Its level of reserves, the fact that its banks are government-owned or government-sponsored, however you want to say it. It's not going to have, but it probably it will have is a Japan-style period of very, very sluggish growth for an extended period of time, a sort of a Japan scenario. But I think it's very relevant. I mean, back to, this takes a while to get out of this kind of a mess. It's a long process. I think China's just entering.
Again, the second question was to do with sovereign debt write-offs by banks, is it right?
It won't work. It's a completely false idea. Because if you write off your liabilities, you're writing off somebody else's assets. Now, if you write off the central bank's assets, it doesn't do actually anything except drive the central bank into sort of negative equity. And it reduces the flow of seigniorage from the central bank to the Treasury. So that's no use. And no central banker in his right mind would even consider it. If you're going to write off other people's debt, it's mostly held by pension funds and insurance companies. Do you really want to make your pension funds and insurance companies insolvent? It's a silly idea. I know a lot of people actually sort of think about it, but if you go through it, if you go through the question of who owns the debt, who is the counterparty to the debt that's being written off, it just doesn't work. Don't do it.
Yeah, I completely echo that. This helicopter money debate, I don't really understand this debate. I mean, I don't think there's any doubt that if there was a fiscal expansion, it would buy you a couple of years of decent growth. We saw that in 2012 when the pace of fiscal tightening was deliberately slowed down a bit. The IMF and Commission agreed that countries didn't have to bring their deficits down so fast, and growth improved as a result. So if you want to get a bit more growth for a while, you can have a wider fiscal deficit. Why go out and fund that directly from the central bank, completely wrecking the institutional independence and the relation? Which ultimately that relationship has to be independent to preserve the currency. If you have central banks printing money and governments paying teachers' salaries with it, it creates some issues, right? We saw that in Latin America in the 1980s. Venezuela's been doing something very, very similar. Why? But there's loads of money out there already. If governments want to go and borrow a bit more money, it's not even free. They get paid to do so at the moment. Yeah. So why would you want to wreck the central bank in the process? I just don't get it.
Okay, thanks. I think we're going to have to finish it there because I'm seeing the clock running down to almost to zero. So let's dispense with the closing statements. I think we can take those as read. But thank you very much, panel, for a very spirited discussion on a very, very broad and difficult subject. And please give them a big round of applause. Thanks.